Good afternoon, ladies and gentlemen, and welcome to this session with HSBC Asset Management. Once again, akin to the RBI's monetary policy calendar, we are here to present to you, and probably the first ones to present to you, the brief highlights of the policy and what's in store after the RBI governor has unraveled some of the key points for the next 2 months. This has been a regular feature from our side. You've been hearing us both on the policy as well as on certain events and certain products, events in the world which we talk about, whether it's equity, whether it's fixed income. So this is one more step in that endeavor. My name is Rajat Handa. I represent HSBC Mutual Fund, and we have two distinguished to talk about the RBI policy, the monetary policy, as well as the impact on markets, on investors, and certain funds from the HSBC basket. So without further ado, let me introduce our distinguished speakers today. We have with us Shriram Ramanathan. Does not need too much of an introduction, but for the sake of protocol, let me introduce Shriram for those of you who don't know. Shriram is Chief Investment Officer, Fixed Income for HSBC Mutual Fund. More than 26 years of experience in the investment world, managing fixed income funds and heading the investment platform across debt strategies in various organizations. So Shriram has been with HSBC Asset Management for many years. Currently, he manages 60,000 crore plus of AUM across fixed income and hybrid strategies with his team. A little bit about Shriram. As I mentioned, he's worked in HSBC. He's worked in L&T Asset Management before HSBC. He's also worked in Hong Kong with ING. So comes across, has worked across geographies, managing various asset classes, focusing on fixed income and various geographies. From an education standpoint, Shriram is a chartered financial analyst. He holds a postgraduate diploma in business from XLRI Jamshedpur and an engineering degree from the University of Mumbai. Welcome, Shriram, once again, and thank you for joining this call. Okay. Our next speaker, and somebody who has been enlightening us and adding a lot of value from an economic perspective, is the SVP Economist and Fixed Income Specialist of HSBC Mutual Fund, Achala Jethmalani. I know Achala is a very popular face now because she's very visible, and she takes every opportunity to talk and share our views on fixed income, on the economy and the markets. A little bit about Achala. So Achala, as an economist and investment specialist with the fixed income team, she joined us about a year and a half ago. Yeah. And she's been covering India's economy and key global economies. She focuses on the economic implications on investments. That's her forte. Achala provides inputs to the fixed income team, which is Shriram's team, regularly on both India and global developments. She has more than 15 years of experience in the financial services space. Before HSBC Asset Management, Achala was the head economist at RBL Bank. Educational background, Achala holds a master's degree in economics from the Mumbai School of Economics, University of Mumbai. Welcome, Achala.
Hi all, thank you, Rajat.
So Achala, since you've unmuted, my pleasure.
Yes.
So since you've unmuted, we would want to hand over the opportunity to kickstart the August proceedings and probably share your first cut on the RBI policy, which is just fresh from the oven. So maybe everybody's eager to hear your interpretation, and then after that we'll go to Shriram. Over to you, Achala.
Yes, sure. Thank you. Hello, everybody. Thank you for joining us yet again for the post-policy call. Fresh from the oven makes me feel a bit hungry, but let me stick to the script. I'll share my screen just to make sure that I have the flow in place. So, of course, I hope my screen is visible now. Yeah?
Yes, it is. And
Okay.
Achala, maybe you can just do a full screen.
Sure.
Yeah.
Yes, I will do that, Rajat. All right. Okay, so I think what an interesting policy, especially when market consensus have been all over the place as to what the RBI policy will look like, especially given the kind of uncertainty we have been jolted with over the last several months. And in our view, yet again, for the third time in this financial year, when it has met in its bi-monthly policy, it has maintained nothing but a calm demeanor amid all the chaos that we have been facing. And therefore, I could not find a befitting heading to this and the policy, which is nothing but poised through the uncertainty. Now, I would just like to focus on two factors that have been the major source of uncertainty when we look at the current macro settings. One, as we are all aware, it has been the crazy volatility that we have seen in oil prices and why that has led to a rapid amount of price swings and in return percolated into sentiments and impacted rates and FX segment across. Okay, so it's over 150 days and counting, and yet we're still navigating whether the energy crisis is behind us or are we still in the face of it, or is it going to worsen? Because if the choke points such as SOH, as the Strait of Hormuz and Red Sea, continue to remain under threat in terms of easy and smooth mobility of ships, then where do we stand, say, 3 months now? But having said that, at least given that crude prices are right now trading at the levels of about $80 a barrel versus close to 100, it intermittently touched just about a few days back, gives us some sense of comfort. And it is happening yet again. Last time when RBI met in the month of June, something similar played out. And today when we meet again on 5th August, a similar scenario has played out where crude prices have corrected quite sharply. So that does give a margin of comfort in terms of where the policy should be headed. That's one uncertainty that we have been navigating. Second is, of course, a little more focused on India. Again, it's more external in nature because of the weather conditions that are expected to play out globally, because of the El Nino conditions that are developing. So that's another external headwind that we're faced with. But India's monsoon has, after a very bad month of June, is starting to look better in the months of July and August. So what we are right now seeing is that monsoon is progressing somewhat better. And because of that, we're also seeing that our summer crop sowing is improving as compared to what it was, say, end of June, early July. So these are some of the other factors which remain a risk area, but there is some comfort that is playing out, and which is why it warrants a bit of caution from the policymakers before taking any kind of sharp policy changes, whether we talk about from the government side or you talk about from the RBI monetary policy standpoint. And therefore, a wait and watch approach that we have been talking about and looking at makes more sense to continue with. This is just one chart on the left-hand side which indicates that how hotter conditions are when we look at sea surface temperatures because of this super El Nino conditions that are expected to play out in this particular year, and how it could possibly negatively impact our monsoon season. We're already facing nearly 12% deficit in rainfall precipitation, but when you look at, say, last 1.5 months, monsoon is gathering pace. So there is some comfort because the monsoon is progressing well. So we need to wait and see how it pans out by, say, end of September. And again, which is why it probably warrants more caution rather than a quick reaction by the monetary policy in anticipation that, hey, inflation is going to look higher and therefore it is better to take a preemptive approach, etc., which the RBI MPC has refrained to do yet again. So I think those were the two major headwinds that the current monetary policy is battling with, because these have direct implications on your inflation and also simultaneously growth. But so far, of course, growth has done far better. Now, in terms of policy outcomes in the current uncertain backdrop has been this. This is how we have interpreted the policy, which is nothing but a neutral hold with a lot of dovish undertones. That was a bit of positive surprise, because we thought that it will be a neutral hold with neutral commentary, given the risks that we are faced with. But obviously, there were some hints of dovish undertones. We will not call it a dovish hold. we would rather call it a neutral hold. Dovish undertones coming out in the way of, say, RBI policy saying that inflation pressures are largely supply-led, core inflation is still very benign, and third being that it is not still getting broad-based. So that's where we are drawing this comfort and reading it as a little more dovish in its commentary. In terms of its forecast and outlook, when you look at growth, it says that growth remains resilient. It is now expecting about a 7% kind of growth for the first quarter, given the kind of high frequency indicators are saying that growth momentum has sustained despite India being in the midst of the energy shock. So that's a pretty robust number. You're seeing some momentum dip, but overall the growth is still in the 6.5 to 7% handle as per our expectations. But RBI is now revising it higher by about 10 basis points to 6.7. So that's a slight positive there. On inflation too, the positive has been that it has revised its inflation forecast for FY27 lower to about 5%, largely drawing a lot of comfort from core inflation, which it is now expecting it to be lower at 4.3% versus what 4.7% it forecasted at the June policy. And that may be because of metal price cooling that we have actually seen play out, why the number could be a little more benign than 4.7. So that again gives a dovish tilt to policy, because the RBI is saying, hey, the headline is looking higher than 4%, which is the medium-term target, but it is not at 6%. Okay, that's one. For the first time, it has even given out its first quarter FY28, which is like 12-month forward forecast, June to June. So when you look at the June quarter forecast, now that has been pegged at 5.3%. But when you look at the trajectory of forecasts, it is actually expected to come down from 5.9% to 5.3%. So that's a clear glide path. If it was to stay at 5.9 or higher, then you would say that, okay, the policy is factoring in that inflation pressures are really high and economy is probably heating up. So that's another inference that we draw from this policy. Lastly, on liquidity, I think another positive was that this time around, it actually reiterated by saying they would want to proactively ensure that system remains in surplus. Okay, so that means whatever flows that we are expecting to come through could indicate that the RBI may not absorb it dramatically to keep liquidity closer to zero. So that's another reading which says that policy remains neutral, not just on policy rate front, but also from liquidity standpoint. Now, in the last policy, the RBI had actually delinked rates and FX completely. When we met in June, that time there was the whole balance of payments, currency-led pressures that were at play, and the RBI brilliantly tackled them by announcing some of these FX measures. So where do we stand on those measures? I think when you talk about policy reforms, or you talk about tax exemptions on government securities and debt flows, that has really favored India considerably. All right, so we've actually seen debt inflows amount to about 8.7 billion till 31st July from 5th of June. And in terms of FCNR flows, ECBs, the swap facility window that the RBI actually announced in the month of June, that has resulted in inflows of about 40 to 41 billion till 31st of July. All right, so I think that's again another positive factor that has played out, supporting the currency level and allowing the MPC to focus on growth and inflation dynamics versus risks spilling over through the currency channel into inflation. So this is how the FX measures taken in June are playing out, and the RBI may want to watch out for these effects to continue and await how this pans out by the end of September, when especially the FCNR window, one of the major sources from where dollar inflows are coming through, how it shapes up in about 2 months' time. All right. So this is where we stand in terms of past policy to this, and why even at this policy it has allowed the RBI MPC to stay on hold. Just a brief comparison over here from 2013, because that was the time when India took a similar measure in terms of FCNR, was how much did India manage to mobilize? these are just nominal terms. But even when we look at it as a ratio of GDP, the current scheme is tracking slightly higher in terms of dollar mobilization. And at about 37 billion in just about, say, 40 to 45 odd days, a 37 billion inflow is quite robust. And there is about another 2 months. So even if you assume on an average, say, zero 0.8 to 1 billion kind of inflow coming through in the next 30 to 40 days, that would mean that India should easily be able to mobilize a 50 billion kind of a figure, right? So I think at least from dollar flow standpoint and the whole balance of payment situation, India's external sector positioning is looking far better now, at least for the next 1 quarter, right? So that's where we stand. The consequence of dollar inflows is also having some positive spillover effects into our banking system, and that's getting reflected in your whole deposit space. So we have the data available till about June. We don't have the broad breakup, but if you look at the numbers, you've seen credit growth actually be higher about 1 to 1.2 percentage points as compared to the previous month. And in June alone, we saw about 13% kind of deposit growth, right? And even when we adjust it for, say, seasonality, how it has performed every year in June quarter, even after adjusting for that, there is an incremental delta that's quite visible, which can be attributed to the dollar mobilization that is happening in the system. And that in turn has helped the banking space to meet the credit demand, which is north of about 18%. Okay, so I think that's another positive impact that is actually starting to play out in the whole banking space. Lastly, I think to conclude, I think what is our view on way forward is laid out in this one particular slide. As I mentioned, in terms of growth and inflation, we are almost in line with where the RBI is. The numbers have largely changed because of how first half of FY27 situation has panned out. At beginning, the West Asia conflict, in February, nobody anticipated that the first quarter could look so robust. But the Q1 numbers, especially GDP, are looking at about 7%, which has changed your full year forecasts to 6.5 to 7. That's the positive. Second, inflation is tracking about 20 to 30 basis points lower than what one thought would be a result of energy crisis. So that's another comfort, which has kept your overall FY27 number capped at about 5%. That's one factor playing out. Second is some bit of support from, say, metal prices. Surprisingly, those prices have cooled off in anticipation of rate hikes, higher inflation, higher rates for longer, etc. That kind of theme playing out. So which has in return benefited the whole inflation trajectory. That's another. In both to growth and inflation, the impact would obviously depend on how the next few months unfold in terms of external developments as well as weather developments. So that's where the focus lies. But at least in a broad scheme of things, 6.5 to 7% on growth and about 5 to 5.1% on inflation looks far more realistic. All right. Of course, inflation is something that one needs to watch out for, especially when you look at perishables, because those prices can swing very sharply, very quickly. And with food having a weightage of about 36%, it can really change the inflation dynamics far more quickly. But as of now, given how things stand, we are looking at about a 5% kind of print. Policy rate outlook in this backdrop, we are saying that India, unlike other EM countries, will not be in a hurry to act on policy rates. The risks are definitely tilted on when the next hike comes. But the drivers of the next rate hike are really dependent on data, how domestic data plays out. As I mentioned, we have to wait and watch how some of these factors play out up until September and October. And post that, there will be a little more clarity as to what India's next policy move should be. Should there be a policy pivot as early as October is something that we are not really anticipating, as RBI meets on the 7th of October next. And until then, we'll just have a few data points here and there. Second is, of course, from the external development point, leaving aside the whole West Asia conflict and it intensifying. That could be a negative factor. But what would be also important to watch out for is how the US Fed policy starts to position itself. As we enter a phase or an era of different kind of communication from the Fed, we really don't know when the first policy pivot by the Fed happens. So that's one another element of surprise that one needs to be watchful of. But given the domestic factors, I think a long pause is something that is the comfort that we are going with. Like I mentioned on liquidity, so far I think liquidity has been in the surplus territory. There have been sharp fluctuations and swings in the month of July too, despite even if we look through the seasonal factors. That's again because of the kind of FX intervention that RBI possibly had to do because of the kind of external environment that we saw and the volatility that the currency went through. As per news sources, the RBI did intervene in spot segment, right, in order to contain volatility. And in fact, Governor in his speech explicitly mentioned that they were against any kind of speculative moves on the currency, and that at least it is out of that self-fulfilling condition that were getting built in up until June. So I think that gives us some sense of clarity that as long as this pause and hold position for the RBI remains, liquidity should be fairly in the surplus zone. And they would do two-sided measures in order to ensure that it does not become excessively sufficient, but it also does not become excessively in deficit. Therefore, the surplus range of 0.6 to 1.1%, as they've highlighted previously in their monetary policy report, is a fair range to work with. And I think Governor repeatedly, even at the press conference, did mention that the focus for them is to have the weighted average call rate aligned to the repo rate. So I think that's in a way a signal that's how they would want their operating target to behave. Lastly, I think, as I mentioned, the June FX measures, how they have played out positively. And if August liquidity is about at 1.1% of surplus, given that oil price volatility has reversed, now oil prices having tanked, currency movements have bettered, the need for intervention may come down if the current situation stays and plays out. So it may not be really out there to suck out system liquidity and let the FX flows naturally play out. So I think that's, in a nutshell, what we think the policy way forward could look like. That's broadly our sense. Shriram, I will hand it over to
I think maybe best to use our top-down score sheet that we like to put everything that Achala was mentioning into a kind of a framework to assess the impact of the various factors in terms of bond market. I think is a good, useful way to really see which factors are really playing a positive role and which factors are something that we need to watch out for. So if we take a step back and really look at the overall situation right now and really focus on the impact on bond markets, I would say the positives are very clearly, I think, without doubt, the forex inflows, the various RBI measures that have been taken, and even the government policy measures in terms of the FPI tax withdrawals, etc. So I think that's a huge positive. We are seeing that reflected both in terms of FPI inflows into the debt market, but also in terms of the FCNR obviously flows as well. One thing to note over here, this could have been a bit more positive if we had really seen, for example, the Bloomberg Global Lag Index inclusion also come through. As things stand, somewhat surprisingly, it's been deferred for now. It's going to be taken up probably in their next review, which is going to be somewhere towards the end of this calendar year. But I think, as you can see from the very muted market reaction to that deferral, I think it is almost as if the markets know that it's a matter of time that index inclusion does happen. And as and when it happens, yes, it can lead to a meaningful inflow into our markets. So I think that was a good thing that markets did not get rattled too much when that deferral got announced. But overall, the positives on FCNRB and the debt inflows continue. Related to that, the systemic liquidity has improved after almost neutral systemic liquidity. We are now as we stand today at about 3.5 lakh crores of systemic liquidity. So clearly, and it's likely to keep going higher. So I think those are the positives. I think where the neutral factors stand, and again, something that Achala alluded to, one is, of course, the global interest rate environment and specifically the Fed itself. I think now with this changed approach by the US Fed in terms of not giving too much in terms of forward directions, etc., I think it's clearly a wait and watch mode, which does mean the markets might be a little bit more volatile, but I think it also does mean that we are dependent on how data pans out between now and end of the year, and at what point really the Fed, if indeed they do pivot towards further hikes. So I think that's something that we would classify as a neutral, not necessarily as a negative. Then, of course, the second one is banking trends, which is our own domestic banking trends in terms of the credit deposit ratio. I think this was really beginning to once again become a fairly big overhang or a negative factor for our markets, given the widening gap between credit growth and deposit growth. And that's got reasonably, I think, to a large extent addressed by the FCNR deposits that are coming through. So I think couldn't have been timed better from that perspective, especially when we are suddenly seeing private sector capex pick off in a very meaningful way. Credit growth, especially to industries segment, really beginning to show a very meaningful rebound. And in that context, this deposit accretion that is happening, I think, is really helping to ensure that this doesn't become a strain on our markets. Monetary policy, again, we would kind of classify it as a neutral. I think this is versus market expectations. I think over here, it's good to just mention that we are coming from an environment where a lot of fears were getting built into the market expectations. Achala already touched upon a multitude of them, whether it's El Nino, whether it's oil prices, whether it's the US Fed. And one by one, we are beginning to see them unwind. And I think from a monetary policy perspective over here, I think while, yes, our base case is the 1 to 2 rate hikes by March of this year, but yes, the timing of that is very uncertain, and it's good to be a bit open about it because a lot of it is going to depend on how food inflation, on how oil prices, and how the US Fed itself moves between now and end of the year. So we'll kind of keep it at a neutral zone, but yes, with the expectation that there is going to be 1 to 2 rate hikes by March of this year, which is still lower than what the markets are pricing in. If you look at the swaps market are still pricing in upwards of 3 rate hikes. So I would say our expectation is a little bit more dovish compared to what markets are expecting. And finally, of course, domestic growth, which is hinging on the little bit of a positive side compared to earlier. But yes, it's not really causing much demand side pressure. So to that extent, it is a neutral from our market. I think the key negatives to watch out for, one is the fiscal policy. I think here a few clarifications from the government has helped ease some of that fear in terms of extra GSEC supply. I think now it does look like the government wants to try and stay committed to that 4.3% kind of a fiscal deficit. And even if there is a bit of an excess, it will probably be very marginal, is what they are indicating. Yes, we'll see how it goes. But overall, I think that fear for now at least has got abated, that the fiscal deficit will be higher by 0.5 to 0.8%, which is what was being worried about some time back. I think now that has got abated to a large extent. And apart from that, of course, geopolitical tensions and inflation trends continue to remain overhang. So overall, if you sum up the whole thing, I would say from a duration perspective, we are just marginally overweight from a duration side. This is despite all the worries and overhangs that we have. And I think that, like I said, the key driver is to a large extent actually liquidity and driven by the flows that are coming in to a large extent. So moving on, I think to the next slide, what I'll just focus upon is, I think this is a little bit of a crowded slide, but let me just put a highlight on the few things that I want to point out. This is the yields on various segments, be it T-bills, CDs, the government securities and the PSUs. The March 26, the levels as of March 26, and then of course pre-June policy when the nervousness was, you could argue, was at its peak, and as of today, following the rally that we have seen. As you can see, March usually is already a tight period. Levels are usually higher, and then we really saw levels in early June really go even higher, especially the 1-year CD levels, the 2-year, 3-year, 4-year, 5-year corporate bonds, all of that really higher than even the March levels by anywhere between 20 to 70 basis points that we had seen. That's the just before the policy. And then, of course, the various measures that were announced in the previous policy, and along with that, the government measures on taxation. And that is what has really led to that reversal that we have seen. And if you look at levels right now, compared to, let's say, the pre-June policy, we are, again, meaningfully lower. Markets have rallied well. And again, you see the segments that had underperformed the most earlier to be the biggest beneficiaries. So your one-year CD levels down about 60, 62 basis points from the June peak. So you could say almost we are back to the levels where we were in end March. And again, just to highlight, end March usually are already elevated levels, right? So we have just retraced back to where we were in end March, and similarly across the various segments. I think if you focus on the table below, which is basically your spreads, corporate spreads or credit spreads, one-year CD spreads over your one-year T-bills, and of course your 2, 3, 5-year corporate bonds over your government securities. Again, you can see that spreads which were already elevated in March at 150 basis points for the one-year CDs and about 105 to 110 basis points on the 2, 3-year corporate bonds and 80 basis points on the 5-year, actually widened towards early June. Subsequently, the rally that we have seen, while absolute levels have come down very meaningfully, spreads still continue to be fairly elevated, right? Your 2-year AAA spreads over government securities are still about 127 basis points. That's compared to 105 in end March, and of course, a peak of 137 that we saw. And similarly, on the 5-year AAA spreads as well, we have seen about 95 basis points spread now, compared to 80 basis points earlier. So I think, and that's what brings us to couple of value pockets. While overall, you could say that rate cuts surely are off the radar. It's now about a bit of rate hikes, maybe 1, maybe 2. Markets are already pricing that in, which suggests a fairly range-bound market. But I think within that, it's our job to try and identify the few pockets that we think can still deliver a little bit of value. And one of them is indeed the AAA spreads, especially in the 3 to 5-year part of it. I think spreads are still elevated. Yes, absolute levels have come down, but like we have seen in this in these tables, the spreads are still higher than what they were in March, and even though they have come down marginally. The chart on the right-hand side really again shows the the typical 3-year spread versus liquidity, and I think that's again gets us to an important point, that how sustainable is the liquidity situation going to be, at least over the next 3, 4, 5 months. As you can see, of course, if there's over a long period of time, we have seen post-COVID liquidity being amazingly surplus and spreads were very low. And gradually, but into 23, 24 as well, we have seen spreads, but till about December 25, we have seen spreads about 80 odd basis points. After that is where we have seen the spike up in spreads, where liquidity became a lot more uncertain and started swinging a lot more. And that's why we have seen the move towards 110, 120 odd basis points. And now we are gradually coming down. Our sense is that with this FCNR flows coming in, liquidity being marginally on the higher side, and RBI clearly indicating that not too many radical measures like earlier worried about the incremental CRR or OMOs, etc., are off the table. I think with that, we do think the comfort of markets on liquidity is going to increase, especially that combined with CD issuances coming down meaningfully by banks because of the FCNR mobilization that are happening. All of these factors can potentially bring down the spreads on the 1-year and the 2-year, 3-year to 5-year part of the curve lower by about anywhere between 30 to 40 basis points. That's what we think is likely to happen, and which is where, again, in terms of leading on with which funds, etc., I think while for, of course, when you compare it with liquid and overnight funds, we still think money market, ultra short duration, low duration funds make a lot of sense, because we are going to see levels in that come down very meaningfully. Similarly, if you look at our short duration and our banking PSU and corporate bond funds, we are really overweight on the corporate bond side, a little bit more on the 3 to 5-year corporate bonds as compared to the 2 to 3-year. So which we have elongated durations a little bit, and we do think spread compression is really going to drive bulk of the return drivers over there. So overall, while from a government security basis, I would say GSEC yields, we are kind of neutralish. Yes, there is a little bit of a downward bias and a momentum, but we do think we are going to be in a range overall over there. But corporate bond levels, corporate bond spreads, and especially the 6 months to 1 year CD levels is where we think there is value. And over the next month, 2 months, I think we're going to see materially lower levels over there. So that's where I'll stop. Rajat, over to you, and maybe take on some of the questions that our investors have.
Thanks, Shriram. I think in the 10 minutes that you took, you've covered most of the questions which we had. But again, our partners on the call are not going to spare you and Achala, so they find this opportunity once in 2 months. So there are lots of questions which have come. Some of them are there on the screen. Some of them we received prior to the call through email. So I'll probably ask both of you, and then we can try to figure out who wants to answer what. So let me start with Achala. Shriram, the question on which funds for what duration, I think you answered brilliantly, so I'm avoiding that. You mentioned for less than 1 year and 2 to 3 years, so very clearly, I think the answer is there. Achala, Shriram just spoke about one of the possible setbacks which happened because we were all awaiting eagerly on the Bloomberg inclusion of GSEC. So although Shriram mentioned that, this has not been any, it has not seen any knee-jerk reaction in the markets, but do you think with all the positives which are building up from the government side, with taxation going away for foreign investors in GSECs and inclusion of various securities coming in for FII investing, do you think the FII flows will continue unabated? And Shriram, Achala, you can decide who wants to answer that.
Yeah.
I think Shriram did mention in his comments. Yes, Shriram, go ahead.
Shriram.
No, I think on the FPI flows part, I think what we have seen so far over the last month, 2 months on the FPI inflows, I would say is probably more about a lot of emerging market debt investors who are probably underweight India because, as you know, we are now part of the JP Morgan GBI EM index with a 9 to 10% weightage. I think given the various goings on the rupee and on the bond yields, etc., I think a lot of investors would have been underweight India in the versus the benchmark. And what we have seen getting covered is probably just the underweights getting knocked off and people getting to neutral. I think in terms of going forward, yes, we do think incremental flows can be there in terms of a bit of a positive, but I don't think it will be a huge positive. I think a bulk of that short covering is probably done with. I think our next big opportunity is going to be as and when we maybe closer to the end of the year when the Bloomberg index inclusion does get announced. Yes, there would be pre-positioning for that, and there would be a much more sizable inflows overall. Yeah, Achala, over to you.
Yeah. Yes, I think as Shriram mentioned, it is just a matter of time when the inclusion announcement comes through. Because when we looked at the report, it did say that there is a lot of positive feedback that has gone into it. And as there's more streamlining in terms of operation in the aspect of it, etc., it is a matter of time that we see it come through. So I think the only line I would have to say is that it is delayed but not denied. So I think that's my reading of the document.
Absolutely. We are all hoping for this news to come in sooner than later. And I completely agree with Shriram and your view. Okay, the most popular and probably the most Googled word in the last 1 month, FCNR. Okay, so there's some questions around that. Okay, so one important point, and which even I was deliberating, Achala and Shriram, is that everything comes at a cost. There are no free lunches. So we all agree that the government has announced this scheme and we expect 60, 70, $80 billion. Who knows, where the bus will stop to come in. But some people are and I'm playing the devil's advocate here and being a little cynical, are saying that isn't this kicking the can down the road? Because ultimately, after 3 years, 5 years, all this money will actually be an outflow. At that point of time, will we shore up our deposits? Will the situation change so that we are able to absorb that outflow? Or what do you think? Is this a durable resolution to the CAD and obviously the currency problem? Who wants to take that?
I think Shriram can add to it later. But I think that requires one entire segment for this conversation, Rajat, really. But yes, you're right. One is, of course, this is something that addresses our current dynamics. But I think just like in the past in 2013, it was like a 3-year maturity, and this time the RBI has actually given a 3 to 5 year window, and a lot of so we need to see where most of the bucketing is. Right now, we just have the headline numbers, right? We don't know whether these are 3-year in nature or 5-year in nature, etc. So that's one aspect of it. The cost of it, I think even the RBI governor at the press conference did mention. But when I look at it, since this may be something that gets incorporated at the RBI's accounting system, it may not bear such a significant cost as one may worry. India's RBI's balance sheet size is about 24% of GDP or thereabouts, right? So I think from absorption standpoint, it should not be such a major issue. And it, as Shriram also mentioned in his comment, this has also helped address India's credit demand needs at this point in time. And it also anchored the currency. Because so this is not really pushing the can down the road in my view. It still helps you bridge that gap, and it's not a negative scheme or a policy approach to the current dynamics that are there. But overall, of course, in future, it obviously then depends how our export and import balances start to play out.
Perfect. So this was something which was required, and I think the government and the RBI have done the right thing. Shriram, anything you want to add to this?
Yeah, I think overall, I think we have to face it that our backs were towards the wall, right? So there was a lot of pressure given oil prices, given the rupee movements, etc., and especially adjusted for the forward position. RBI's net FX reserve position was beginning to look fairly on the lower side. So I think in a way, desperate times do call for desperate measures. But I think the good part is this actually is I think one is, of course, addressing like you said, pushing the can down the road to some extent. Yes, it is borrowed money. It gives us 3 to 5 year time frame. Finally, the money does need to get returned. But I think the other benefits are more in terms of just the fact that it helps us get over a crisis period, right? It's not as if for the next 3-5 years we're going to continue seeing the West Asia continue, or so hopefully at some stage the really the things calm down on that front. And the second thing is that it has a lot of other benefits, whether it is the whole addressing the credit deposit challenge, which is huge for us because deposits are just not keeping pace with the credit growth. I think this helps address that at just the right time when our private capex is finally picking up, because we have been talking about private sector capex growth showing green shoots of picking up for the last 3-4 years. It's just not been happening. I think finally now we are beginning to see that, and I think the deposits really help to give a fillip to that. Liquidity is the other thing. I think liquidity was fairly low. This helps address that liquidity challenge. So I think on multiple fronts we are seeing advantages. But yes, the fact remains that this is borrowed money. It needs to be paid off. Hopefully, the world will be a little bit better in 3 to 5 years, and hopefully, India will be a lot stronger by that time as well to be able to pay that bill off.
Yeah, and I think I'm not as qualified as both of you. I'm also an investor and a second-hand user of information. But I think if I recall the last one which happened between 2012 and 2013, I think it was very, very effective, and it served the purpose, right, Shriram?
Yes, absolutely. Yeah. Yes, without doubt.
Great. Okay, next question is for Achala. Achala, a quick recap on the 3 deficits, or probably one of them has turned into a surplus now, so you can enlighten us. So what's the outlook on, and what's the number on the current account deficit, the trade deficit, and the fiscal deficit, and how do you expect this to pan out in 2027? Is it going to be better or worse? Achala, we can't hear you. Achala, we've lost your voice. No, Achala, there's some issue with your audio. But Shriram, you want to share your perspective on this?
Sure. Can you just repeat the question?
Yeah, I said the current account deficit, the trade deficit, and the fiscal deficit. Basically, these are three things which foreign investors and institutional investors look at. So, what is your view on in 2027? Is this going to be better or is it going to be worse, the way things are acting out right now?
Starting with the fiscal deficit, I think, like I was alluding to earlier, that was a worry for the markets. The 4.3% that we have as target. The worry was that indeed it will increase by as much as 0.5 to 0.7%, following all the oil subsidies, petrol subsidies, etc. And I think the good part is the finance ministry has very clearly and emphatically communicated that they don't see that happening. That they have enough pockets that they can really manage in terms of expenses, and they would be keeping the fiscal deficit within control. So I think with that, I think that worry for now, I think we should park it there, because so far the credibility of this government as far as fiscal deficit is concerned, they have stuck to their promises. So maybe a 0.1, 0.2% increase might be there, but I don't think anything meaningful beyond that, which also means that from a supply perspective for us, the government security supply, I think there's not that much to worry about as of now for this year. So that's as far as that is concerned. Current account trade deficit, Achala, if your audio is back, you want to take that on?
Yes.
We can hear you.
I think so. There is never a webinar where I'm not audible at least once.
That's okay.
All right. I think the deficit, Shriram covered it. The deficit situations are looking far better, at least from balance of payments and trade deficit standpoint. The fiscal headwinds remain because of the energy crisis that we are into. But as far as the absorption of it goes, the fiscal slippage, 0.1 to 0.2% upside risk to the 4.3% rate remain. But we still have about another 6 months to go, right? So I think a lot can happen in those 6 months. But we are watchful of upside risks. As of now, we are maintaining our view that it may not transpire into higher market loans at least. And even if it's the headline number goes, say, from 4.3 to 4.4, it should not be materially denting per se. That's one part of it. The other is trade deficit and balance of payment and the CAD, so to speak. It has been subject to a lot of volatility. It's really a direct function of how your oil prices play out, because nearly a third of your import bill every month is being attributed or assigned to how your oil import bill is. That's almost a known fact. Anywhere between 25% to 30% depending on prices, right? And this time it is not just price, it is also about actual supply hitting the markets. So even if we see a better number in import bill, it in a way indicates that volumes have also gone down. Yeah. It's not just the price effect playing out, because this time supply is also hit. But overall, if oil prices, say from April onwards to now have averaged about 92 to 93, and if they stay at about $80 a barrel, then we could see that prices will move towards 90 and lower. So that gives a lot of comfort on the CAD, which could mean about 1.5% to 2%, which is broadly okay and manageable. That's one. This time India's story has shifted more towards invisible earnings, both via services as well as remittances. They have been very sticky and very robust, so that gives a lot of comfort on the CAD. And we should be able to navigate the shock. The concern was on capital accounts front, the capital inflows, and with RBI's measures, if really the $100 billion figure comes true, then of course you're looking at a balance of payment surplus, which could be very healthy. Because up until 31st July, if you've mobilized about 40 billion in terms of incremental inflows, then it automatically says that you are moving into a BOP surplus. That was something that was not even visible as early as June, right? So your currency may not always reflect it, but your fundamentals are pretty much in place to ensure that your balance sheets are in a much stronger place. So that's our take on deficits for now.
Absolutely. Thank you, Shriram, and thank you, Achala. I think you explained it very well, and I think the outlook also gives a lot of comfort that things are only improving from here on. Okay, let's take some questions which are coming in live as we speak. I'll encourage, we have another 10 minutes. I'll encourage our listeners to put in their questions. So let's take this from Vedika Saraf. Shriram, do you expect a rate hike in the second half, and what is your view on the GSEC yield? I think that's a very regular question which comes in. Where will the 10-year be? It's a kind of a flagship question for all of us in every call. Please.
Yeah, I think in terms of from rate hike perspective, I think we have covered that. Achala also mentioned that overall we think that about 1 to 2 rate hikes by March is what we think is still possibly on the cards. Just that the variability around that and the uncertainty around that is there. And like some in the market are, there are enough in the market who are expecting no rate hikes as well till March. So it is a fairly divided house now out there. Expectations are broadly fair. In terms of our own expectations of 1 to 2 rate hikes, I think the broad reasoning is, I think Achala already touched upon that. If we are going to have an average inflation for the next 2 to 3 quarters at around 5% and higher, at some stage, real rates, etc., do require some amount of rebalancing. The second thing is US-India rate differentials. I think that's also a parameter that RBI somewhere has to keep a lookout on. So all of these factors, and of course, the other things that we already mentioned, which is US Fed and how they and when they move. So all of these factors are there. So we would still, rather than oscillating too much from one end to the other, we would still hold on to our 1 to 2 rate hikes by March. Just that the timing of that, whether it's the October policy or December of Fed, it's going to be a tricky one in terms of at what point enough is loaded up for the RBI to take action. So that's on the rate hike side. But like I said, if you compare it with where the markets are pricing in the swaps curve, for example, the 1-year forward swaps rate is already pricing in more than 3 rate hikes. So that's where the markets really stand. That's where our market pricing is already kind of tuned into. So if we get only 1 rate hike by March, for example, that would be a much more dovish outcome than what the markets are pricing in. So that's as far as that is concerned. Second is in terms of yields. Overall, in terms of from a GSEC yield perspective, we have the 10-year GSEC is around the 678, 680 kind of a level now. Our own sense is another 10 to 15 base points lower. Yes, it is possible. For example, if we had seen the Bloomberg index inclusion actually get confirmed, I think we would have probably seen that 10 odd basis points move. That's more a momentum driven thing, but yes, sentiment and momentum could have taken it down there. We still think that yes, there is a little bit of a positive bias given the way West Asia is cooling off, oil is coming down, but it's still very volatile. But as and when a bit of medium-term certainty comes into the whole thing, I think markets will then price in a little bit more firmly in terms of yields actually cooling off. So, but it also means that there's not too much downside to yields that we are seeing from here. Maybe another 5-10 basis points lower. A lot of the spreads, internal spreads, the 5 to 10 year, 10 to 15 year, and even the 10 to 30 year, 10 to 30s, all of them are also kind of closer to their means over a period of time. So we don't expect too much of a significant spread compression necessary to happen. I think what could happen more is, I think, trying to ascertain where some of these FCNR, these flows are going to get deployed. And I think that is probably going to continue to be the trade for the next 2 to 3 months. One of them is obviously your 5-year government securities, 5-year HBLs. We are already seeing 5-year government securities start to perform well. So segment-wise, I think that segment probably a little bit more than the 15-year plus segment is our preference. Second is the corporate bonds also in the 3 to 5 year space. I think a lot of banks who get this money might want to park this money into 3 to 5 year AAA PSU bonds. I think that's the other space that I think we expect, which is what, like I mentioned earlier, spread compression is fairly likely and possible, and it's worth playing it out for. So I think these are the kind of areas that we think money deployment happens. Generic level of interest rates, I think, is going to be fairly stable as far as the 10-year GSEC or the longer end government security curve is concerned.
Yeah, thank you. Very elaborately explained. Okay, a couple of more questions left, and then we are just about the hour, just on the hour. Achla, request you to don your currency hat because couple of questions on currency, okay? And you can't escape by saying that I'm not a currency expert. So you'll have to answer this. Hari Ramachandran has articulated this very well, the question, and there are a couple of the questions related to this and backing him. And I also want to understand from you, Achla, that there have been a lot of measures in the last 6 months by the government, by the RBI to intervene in the FX market. So a 12-13% depreciation is not natural, right? And we have seen that in the rupee over the last year or so. So in spite of the FCNR lure, in spite of RBI selling dollars and the reserves have also reflecting an RBI, a very active RBI intervention in the last 6 months. The rupee is not clawing back. It's not strengthening the way it is supposed to be. So what are the structural factors which are preventing the rupee to come back in spite of all these measures which we are waxing eloquent on?
It's a pretty exhaustive question. I'll try my best to answer. There are various metrics to assess whether currency is overvalued or undervalued. All right. So the most typically used method is how it stands with its key trading partners. And when you look at that number, it is down by about 7 to 8% over the last several months. It was only in the month of June where on a sequential basis you saw some kind of appreciation. All right. Now, that's also because when you look at India's inflation levels and when you look at other countries' inflation levels, they've diverged dramatically. And that also starts to play out in your currency levels, which is why our currency looked far more undervalued as compared to other countries, coupled with the nominal depreciation that we saw, which was quite telling because that was the phase since the West Asia conflict played out. The concern about CAD widening and capital flows that were really drying up were resulting into a weaker currency. And that weaker currency led to this anticipation that the currency will keep depreciating. The whole self-fulfilling prophecy a conversation that we were having around the currency levels. So that was in a way playing out. Now, what is really needed to ensure that the currency appreciates? You just need to have a better balance in both current account and capital account. And until that is struck, you're not going to have an appreciating currency. So I'm not sure what is the kind of level one individual is wanting to look at on the spot currency level. That is debatable because whether you are saying you want to get it to 90 or 88 or 94, 92, there's no real answer to that. What is the right level? Okay, because as I said, one is a spot currency, the other is your REIT currency. And REIT is now starting to get better and stabilize post the June FX measures. And I'm assuming that would be something that will play out for July as well. I wish RBI governor in his recent interview had given more takeaways in order to say how is it that they are looking at it being undervalued. So I don't know but these are the 2-3 measures that we look at to assess. And structural factors, as I said, either our import bill starts to come down or we start getting better on our exports. And hopefully with bilateral trade agreements in place, we should get that edge in our merchandise goods eventually in the next few years that can help us do better on CAD. And I think currency pressures is something that is a worldwide phenomena playing out at present.
That's right.
So I think India is not isolated in that sense. It has been a whole global rate story, both FX as well as global bond yields. So I think it's a function of a lot of these factors playing out. But on the FX reserves part, I think one is also about the FCNR flows coming through, but it may getting reflected in our reserves and also the kind of RBI's net short forward position that we have. Governor mentioned that it is some of it is unwinding and maturing. So if that is the case, that means some bit of dollar outflows are also happening because the book is maturing, etc. So a lot of factors are at play, and therefore the rate of appreciation that one may envisage because of the 40-50 billion kind of flows may get offset by some of these factors.
Yeah, and I think what we've been experiencing in the last...
I hope it addresses your question.
Achla, absolutely. And I think I thank our partner to ask this question and to give some comfort to everyone. From a 12-13% deceleration, we actually now hit probably ground zero, where we've seen a stability in currency over the last 2 months. So, one should not expect a complete reversion to the mean, from falling, flattening, and then probably, as you mentioned, with the BOP and things turning out, maybe appreciation. Okay, this one is for Shriram. Shriram, you've already answered that. You can let me demonstrate my attentiveness to your answer. So the question is, Shriram, I am an institutional client. What should one look at for investing for the next 3 months to 1 year? So if I was Shriram, I would say look at the entire spectrum, starting from ultra short to low duration to money market. Shriram, anything else which I missed out on, where you want to score me?
No, I think you've got it absolutely right. Simple answer, but yes, it does make sense in the current context, like I said, especially because I think apart from just a yield pickup, I think it's also a potential for capital gains through yields coming lower and spread compression, like I said. So I think all the more reason to really get into some of these funds rather than staying invested in liquid and overnight.
Yeah, perfect. Let's continue on this. You mentioned, I mean, people are trying to gauge when the next repo rate is. Somebody saying December, somebody saying October. But there's a generic question on the outlook for banks and NBFCs if the rate hike actually happens. I don't know whether it's more equity related or fixed income related, but Sriram, your view on this?
Sorry, I lost you there a little bit, Rajat.
I'll repeat. What is the outlook for banks and NBFCs in case the rate hike happens sometime in the last the third quarter of this financial year?
You mean from an equity price perspective, from a NIM and earnings perspective?
Samarjeet is just asking a generic question. You can maybe comment upon the NIMs and yeah.
Sure. So I think overall, I would say it's all about expectations versus what is going to happen. I think, like I said, we are coming from an environment where broadly the expectations of majority of the players, even NBFCs, banks, etc., at the start of the year, in terms of their own expectation for this year, was in terms of 2 or 3 rate hikes, costs going higher, borrowing costs going higher, etc., and of course on the lending side as well. Where that is deviating a little bit is that the pace of that increase is a lot slower now, and it's a lot more, and I think we are consolidating a fair bit more at that lower level rather than heading up higher as quickly as everybody thought earlier. So I think to that extent, it's a good thing, especially from NBFC's perspective and all. I think it's a very good thing that their borrowing rates remain closer to the lower levels. And of course, on the lending side, they're given their segment that they operate in, they'll be able to charge their respective spreads. I think for the banks too, I think especially again coming back to the FCNR deposits and the fact that they are free from CRR, SLR, that they are relatively cheaper for banks overall, and really help them to meet credit growth requirements right now, which means that they are lending at fairly attractive levels as well. I think it's overall a good environment, I would think, for NBFCs and banks right now. I think the whole worry of borrowing costs ratcheting up higher very quickly, how will that hit, now has got postponed to a later date. So we'll see when that comes.
Perfect. Achala, Shriram, do you have time for 2 more questions or can we wrap it up? Achala?
I'm okay for one of the questions. You
Perfect.
check with Shriram.
Fine.
I think he's been a bit under the weather.
No, I understand. So maybe you can take some burden off him and answer these questions. Okay. So let's take 2 more. Sorry, ladies and gentlemen, we're running out of time. Okay. So Shriram, you'll have to answer this. I don't know whether this is appropriate for me to ask Achala, but there's a question on CDs. You can read it. Mayank is asking about the short-term rates. CDs continue to trade 1.55%, 155 basis above T-bill. Is this kind of a limit which we have reached? Do you see some kind of a compression happening? What is your view?
Yeah, I think I kind of touched upon that. I think I think it's a combination of 2 things. One is, of course, the pressure on banks on the deposit side, because of which there's a lot of reliance on CD issuances in general. leading to much elevated spreads. Second is, of course, the surplus liquidity situation. It's being fairly, uncertain. And that was the second factor that was also having its own cost. So which is why CD levels have been fairly elevated. Spreads have been very high. We do think, like I said earlier, we are due for a fairly significant spread compression and yield movement lower as far as CD levels are concerned. We'll see that probably pan itself out over the next month or 2 months as this whole because what did see is FCNR initial a lot of mobilization was by foreign banks. Slowly it is spreading a lot more to the private banks and the PSU banks, and that's where really CD issuances will start reflecting that reduced need for CDs itself. And accordingly, once issuance starts coming down very meaningfully is when spreads will start coming down. I think a lot of money on this expectation is likely to flow into money market funds and ultra short and low duration industry as well. And suddenly you'll see the demand supply really switch over and which will cause a drop in spreads and CD levels. So yeah, I mean, I'm repeating this again, but I do think that CD levels are due for a fairly significant move lower. And the one probably needs to be prepared and invested for that.
Okay, thank you. We'll take one last question. I'm sorry, I'll have to skip this question on the red hex positioning and strategy because Shriram and team have done a wonderful job. And I'm just saying that the portfolio is structured in such a way that Shriram needs at least 15-20 minutes to explain the strategy and the positioning going forward. So sorry, we can't do it in a minute. We'll probably have another session, Shriram, with our partners to explain that. But the last question is the other extreme. So somebody asked you, Mayank asked you about the CD issuance. There's Ankur Sharma who's asking you about GSECs. Probably they are holding GSECs for 20 years of maturity and gilt funds of more of 10 years. Now, I may 15 bips kind of a rally. What do you suggest to this person right now? What should we do? Should they hold on to the gilt fund or should they diversify?
See, overall, like I said, I think we do expect overall levels to be a bit range bound as far as government securities are concerned. Yeah. But what is likely to happen is obviously in terms of tactical opportunities that will keep opening up, right? So right now, for example, the 5-year segment, 5-year GSEC segment, the 5 to 10 year or the 8 to 10 year, let's say HDL segment, there are segments of value that are there which can lead to some amount of trading opportunities, tactical opportunities. And I think that can lead to still a meaningful return profile for the gilt fund. But having said that, it's different from a time when one would expect, let's say, a 50 basis point move lower in the overall generic level of interest rates, and that's the reason for investing in a gilt fund. I don't think now is that kind of a period. It's more that generically, I mean, we are at the low of our rate cycle. We are preparing for when that rate hike will happen. It's got delayed a little bit. I think the positives and negatives are all counterbalancing each other in many ways. So I think we are really saying that levels should be somewhat range bound, and it's more tactical opportunities, trading opportunities that can add value, and there are quite a few of them. So we do think we are on it in terms of identifying those pockets of value for our gilt fund, and to that extent, I do think yes, I think it does make sense to stay invested from a gilt fund perspective.
Perfect. Very straight answer from you, and I think Ankur has got his answer. Thank you so much, Shriram and Achala, for being on this call and also extending the session. Shriram, health permitting, thank you so much for sharing your time with us. Achala, always a pleasure to hear your thoughts. And ladies and gentlemen, I hope this was a value addition to you. We've been able to explain the basic tenets of the policy and exchange with you our thoughts and our views on various segments, including currency, including inflation, GDP, fiscal deficit, and God knows what all. Time was limited, so we had to skip some questions. But with the assurance that Shriram and Achala will be available once again and will present to you the October policy highlights. And obviously, if something comes in between, like the red hex, if you want to know a little bit more, we would also urge and request Shriram and team to address you again on those aspects. So with that, thank you everyone for attending this call, and it's goodbye from all of us from HSBC. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.